All right. Hi, everybody. Thanks for being here on a beautiful Friday. We're excited to have you all and to have our presenters here to talk about loan programs for agricultural producers. So this is a brief overview of the event today. We are joined by Andrew Wood, Tracy Derry, and Alex Robb. And they're each going to present on their respective lending opportunities for about 20 minutes, and then we're going to have about 10 minutes for questions. So we're going to start with Andrew Wood. So Andrew Wood is the Director of Agricultural Lending at Vermont Economic Development Authority. He attended UVM, where he received a bachelor's degree in animal science. He also earned his associate's degree in dairy farm management from Vermont Technical College. He previously held the title of President of the Board of Directors at Vermont Dairy Industry Association, and he has been with VITA for 12 years. We're thrilled he's here with us today to share his wealth of experience and knowledge in agricultural lending. So please welcome Andrew Wood.
Excellent. Thank you for that introduction. Excited to be here today representing VITA or the Vermont Economic Development Authority. We're a statewide economic development lender that has loans serving commercial businesses, energy projects, and agricultural and forestry businesses. I'll be talking mostly about our ag and forestry loans today. If you have questions on commercial or energy loans, I'm happy to take them. If I don't know the answer, I'll get them to those who do. Our ag and forestry loans offer a broad range of loans. We'll get into it a little bit. I don't have too many details here, but I think we offer a competitive, a flexible range of loan products at competitive terms. So reach out with any questions. As I'm going along, if people have questions, I will take them as I go. But we will also have time at the end. If somebody does raise their hand on the screen, perfect. So I'm going to cover a little bit of a broad background and some overview before getting into specific things for us, and then maybe some specific things about grant funded projects, as I think that was something that was relevant to people. So some things I'm going to cover are what do lenders look at as we consider making loans? Kind of how do we go through that process? What are some of the key things? I've got a few things maybe people should think about when they're choosing a lender, maybe besides the obvious things that people might think about. I'm going to talk a little bit about the application process, because I think if you haven't accessed agricultural or commercial credit before, maybe a different process than you might be used to. I'll talk about our offerings, and then I'm going to talk about some considerations for grant projects, and then some things that make for a successful lending relationship. So if I do well, I'll do that all in less than 20 minutes. So how lenders make decisions, I'm not going to tell you anything that you couldn't look up in a book here. The 5 C's of credit, I just bring it up because this is how lenders make decisions. Every loan that a lender makes, or anytime somebody gives somebody money, all of these things are considered. Maybe they don't play a factor in that specific transaction, but these are the things that lenders look at. The first being character. Number one, does a person have the knowledge, the experience? Are they somebody of good character to make a loan to? Credit history comes into under this. See, they are the 5 C's of credits. Repayment capacity. You'll hear it called capacity, but we're talking about cash flow and profit. Do you have the ability to repay this loan? Most of the business loans that we do, ag and forestry loans, we're looking at the profitability of the business to repay the loan. Or if we are looking at maybe some type of bridge financing or other things, at least the profit of the business to cover the interest of that loan. Capital, this has to do with the overall financial position of the business or the individuals involved. Do they have the resources to be successful at operating their business or whatever venture they're looking to do. This one becomes pretty important when things don't go as planned, as things so often in this world don't go as planned. This becomes one of those factors. Collateral is another thing we look at, and that's how do we secure the loan? Is the loan secured? Not all loans require collateral, but a lot of loans do, right? So like example would be a car loan is secured by the car. But loans can be secured by a wide variety of things. And so how does that influence the overall thing? And the last C is conditions, and this can mean a couple of different things. So it's either the broad economic concerns, so it could be the conditions of the economy, the conditions of the industry you're in, or it could also be very specific to the loan, a condition of the loan. For example, a construction loan, a condition on that would be, where are you in the process of constructing? What constraints do we have? Lines of credit would have different conditions. So all of these 5 Cs, you can see in different types of projects how these may or may not be weighed differently, right? If we look at a credit card, for example, that is something that you lend for. However, probably never had a question about your capital or collateral on a credit card. Those don't come into play. The lender has made a decision, and that's why you pay a higher interest rate on that type of lending, is because of those things. And we can see on a variety of projects or different lending products how these may or may not come into play. But these are things that lenders look at when they're making a lending decision. And I'll also note that as business owners looking to take out financing or things, I think thinking about these things and how that interplays with your project can be useful, right? It helps these. We look at them because of the risk to the lender and how does the loan align with our programs and our risk tolerance. I think that same decision can be made by the person taking out the loan. How do these increase or decrease the risk for that individual borrower? I have a few things here that you might think about, people might think about as they choose a lender. The first one, is a kind of a simple one, but does the lender offer the right loan products? So thinking about what you need and how you might do that. For example, we'll talk about grant projects today and the possibility of bridge funding a grant. Some lenders do that regularly, some lenders don't. And so they may ask different questions on how that works, what they're looking for. If they don't have experience doing it, that may make it more difficult. Annual operating lines of credit, if that's what you're looking for, if the lender doesn't offer that, you may end up finding yourself with a different lending arrangement than you want. Does the lender understand your industry and your financials? I should be looking at you, shouldn't I?
That's okay.
You make good eye contact with me.
Yeah.
We're great.
Yeah, there we go. So does the lender you're working with understand your industry or your financials? If you're if within agriculture, a lot of lenders today don't have much agricultural experience, or they may not understand your financials. They may be used to GAAP financials or other things where they don't understand some of the things that you're coming in at, what you present. It may make a lot of sense to you. They may not understand it. I commonly find that I, as somebody with experience in these agricultural fields, can understand what was trying to be conveyed, even if it doesn't align with GAAP or best practices. And so I think there's some value in that. There's also value, especially when you look at building long-term relationships, working with somebody who understands the industry. You take a year like, it was 2023 was the frost year, I believe, right? When an apple orchard calls me up and says, oh, we're experiencing this issue due to frost, I expected that call. I may have reached out to them before they reached out to me, where if they don't work with somebody in this industry or with those things, that may become a much more challenging conversation. And you can look at that in any industry.
We do have a question.
Okay.
What is bridge spending?
I will answer that later on. I will get into it a little bit more specifically what I mean by that. It is a good question because it can mean a variety of things. And so the last thing I have here is the lender's process. Does the lender's process align with your project and your needs? I think that's a good question to ask. There's a broad range of processes and ways to access credit. I'll say if you want $2,000, our process is probably too cumbersome and too long for you. There is probably a better way to do it. Same idea if you want, if you're looking at truck financing or vehicle financing, we may not be the right course for you. However, maybe you're not getting a rate and term that is competitive and you're not crunched on timeline. Maybe you do want to work with us because we offer a better rate and term. But those are some things, and I think all of these kind of come into play. I think thinking about what your project is makes a big difference, right? You are looking to finance your farm purchase for your first time. Probably you have a little bit more flexibility, more lead time. That one may not be as important. Where you've got some type of project you're trying to turn around very quickly, we may not be able to do it. So talking a little bit about those. So all of these are some other things I think about when you're choosing a lender. I'm going to talk a little about the application process, walk through that, how some of the things, because as I mentioned earlier, I think our application process may surprise some people if they've never accessed agricultural or commercial credit. The initial inquiry, pre-application discussions, we welcome those discussions at any point. So I did put it on here. Always happy to have those discussions. Then kind of the next step is going to be the application being submitted. We have a complete application form, but then financials. We look at a lot of financials for which is consistent for business or agricultural financing. So we're looking for balance sheets, certainly a current balance sheet, historic balance sheets if you have them, tax returns, production information, and income and expense projections. At a minimum would be some things we would be looking for. Then we're going to need additional items that may be needed, things like corporate documents, leases, purchase and sales agreements for real estate transactions, potentially a business plan. In all situations, we don't necessarily require a business plan. In many instances, we would be looking for a business plan. And this is not a comprehensive list. This is just some of the items, the most common items that we need every time, or quite commonly. Once we have those, once we have that complete application, we're going to move this to underwriting. During underwriting, we may have various questions, may lead to more documents being submitted. We're trying to verify that information, make sense of what we've received. And so that can lead to any of a variety of things. We almost always do a site visit to meet with the applicant, see their business, see the project they're looking at as a part of that. I throw in the appraisal as one step here because if it is a project that does require an appraisal, typically projects requiring financing new real estate purchases, real estate improvement types things, we commonly would require an appraisal. And that can be an important timeline in this. At some point in here, we would look for an approval and then move towards closing. And then I wanted to just throw a timeline. If it's a non-real estate transaction, maybe 3 to 4 weeks for us is the timeline that we're looking at. Where real estate transactions, maybe 6 to 12 weeks. And I did put the caveat on the slide. Both of those timelines are once the application is complete. If we get incomplete an application and we spend a long time going back and forth to get all the information we need, that could be longer. If you have a situation where you need it to be shorter, give us a call. Let's have a conversation. Maybe we can accommodate you. Maybe we can't. But I put those timelines up just because I think sometimes people are surprised by that they're not as fast as some other processes might be. So what do we offer, Vita? So we have loans for a wide variety of uses and purposes for ag and forestry businesses. And I'll say also closely associated within our ag and forest program, we also work with closely associated businesses. So businesses that may process raw ag commodities, that may harvest or transport raw ag commodities, a few other things fall in there as well. Primarily, some loans that we offer, things like operating loans if you're buying equipment or livestock purchases, really any needs. And these are just some common things. Real estate purchases, real estate improvements, lines of credit for annual operating needs. And then bridge loans. So I wanted to list this as we talk about grant projects today a little bit. I will talk about bridge loans. And when I'm talking about bridge loan, I'm talking about a short-term loan. For me, short-term, I might mean up to a year, where we are bridging some type of anticipated funding coming in, usually a grant or other things. So pretty commonly, a grant might be on a reimbursement basis. We would provide a loan to get the project completed, and then we would be paid back when that grant comes in. We would call that a bridge loan. May not be the term everybody uses for that. That is a term that we do utilize. I believe we have some competitive interest rates at the moment. We offer agricultural and industry expertise. Our lenders that work in this all have experience, many of them with decades of experience in the agricultural industries and specifically in lending as well. So I believe we have that expertise. Local service. You will be talking with a lender here in Vermont. Credit analysts are based in Vermont. You will know your lender and work with them throughout. And some considerations for loans specifically on grant-funded projects. So I believe one of the things people wanted to know a little bit about today was loans with grant funding. One of them I have is, how is the grant funded? Does the grant come in up front, or is it a reimbursement basis, right? That's going to make a big difference on how much money you need, when you need the money. A lot of grants require the project to be completed before the grant is dispersed. Either in those instances, either the borrower has to pay for it, the contractor has to wait to be paid, or they need some type of financing, like the bridge loan I referenced for that. Next one, very closely associated with that, is what has to be completed to earn the grant proceeds. So understanding that, what is it? When will the sign-off actually come? And along with that, when do those payments come from? Right? And can you earn it at increments? Do you earn a portion of proceeds at 50% complete? While it's a big project, is it actually broken down into individual projects that get signed off on along the way? All of those can make a big difference on both the amount of money outlaid and kind of the cash flow of the project. Along with proceeds, if you're working with a lender specifically, primarily for bridge funding, a question might be assignment of proceeds. This would be where whoever is issuing the grant proceeds will allow the lender to become the person paid. So NRCS typically does allow this, in my experience, where RD does not, the state of Vermont does not. So some differences there. Question around what is being financed. So some of these are large projects, right? Are you coming to financing just for the your cost share? A lot of these, a farmer may get a grant for any percentage of it. Maybe it's 50%, maybe it's 90%, but whatever that remainder is, sometimes they need financing for that. In other instances, they're able to handle that cost share piece, but it is that bigger piece of the grant that they need bridge financing to handle that. Along with that bridge financing, making sure that that is accounted for in the loan. When I first started, bridge financing wasn't as big of a deal. If you all remember, interest rates were quite low for a long period of time. When interest rates increased, cost of a bridge loan may not be insignificant to an overall project, especially when we look at really large projects. Think of an NRCS or EQIP manure project. If you bridge fund that and you end up with large amounts of money on a bridge loan for periods of time, we may be talking thousands or tens of thousands of dollars in interest expense for that. Additionally, closing costs can be expensive as well if we are again talking about some of those NRCS EQIP projects. If you get into taking real estate as collateral and how that's accounted for, that can involve lawyers and those things. So get an estimate of closing costs because those again can be very significant. On time. Okay, I'll go a little faster through a few of these. So question, what's the risk of non-completion of the project? Is there any risk? Or is there a big risk? And is there a risk that you put money out and then you're not able to complete it? Something to think about. It certainly is something a lender will think about, but I think it's something anybody taking these projects on should think about. And then something for today's environment, is there any risk the funding could be removed before completion of the project, right? It is something to think about. I think fortunately most projects that had incurred costs, that wasn't an issue that I have seen. But certainly it was something that was talked pretty heavily about for a period of time. For us, Vita, when we do loans, our loans are collateralized throughout the project. So we do look at collateralization. A lot of our smaller projects, we're able to figure this out. When we get into larger projects, like I've referenced a few times, like an NRCS EQIP project or something like that, that can be we would be looking at taking a lien on the farm, depending on the position of the farm, that may be easy or not as easy to figure out. Certainly something to think about. Timing of when to apply. We're happy to discuss the project at any point. In the best case scenario, you're able to apply between the time that you have been awarded funds and the time you put the shovel in the ground, right? That's the time frame. Going back again to that timeline I had. So, if everything's in a short period of time, that may not work in the timeline. We may need to be working on it ahead of time. But it's always a concern, especially for competitive grants. If you're asking us to process an application before you've been awarded a competitive grant, because it may or may not. If you're doing the project either way, whether you get the grant or not, then we can start at a very different timeline. But if everything is contingent upon the grant, in the best world, we do start that at the time you have that award and before that. The shovel goes in the ground. And if we are underwriting a grant project, we are going to want to see those grant documents. So any of the award letters or if you've got the signed contract, so that we understand the specifics of the grants, of some of these particulars that we talked about. And my last slide with information on it, the keys to a lending relationship. I had the 5 C's of credit before. I think this is the 5 C's of a good relationship, and that's communication, 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 communication. Did I manage to say it 5 times? But it's very much overly simple. But the key to any relationship is communication. It's really no different. Reach out proactively as you see there are issues, as there are, certain things that may be changing or those items. Reach out and have that. Just a good dialogue back and forth is always helpful compared to, sitting down for an annual meeting or something. And that's when we find out something major occurred 6 months ago. That's not a good way to figure those types of things out. And then the other thing, maintain and provide the lender with good records. If you're able to do that, you're going to find that your lending relationship can improve greatly. The speed and efficiency with which we as lenders can serve you improves. and we're able to change our conversations around what are the needs for the business and what things go forward, as opposed to trying to spend a lot of our conversations deciphering your records and your current position. So a couple of key tips for a successful lending relationship. And I'll end here with my contact info. Always welcome any questions and to talk through any projects or specific things. And I think if I'm correct, we have a fair amount of conservation district staff on the phone. And so, you may not have questions on as a lender, as a borrower, but maybe programmatic lending questions or other things like that. I'm always happy to field those types of questions as well. So thank you.
Thank you, Andy. That's great.
My question's going to be probably broad for every presenter, but so we're a vendor for precision ag installs, so there's a lot of CEAP grants awarded for that. And there's several issues with that. The application process is in the fall. There's like a 3-month waiting period. People get awarded in January, and grant completion is due by, I think, the 1st of June. So we've got like a 4 to 5 month turnaround period. And in that period, we'll do roughly $250,000 worth of installs. So at that time, I'm going to put a ton of cash forward on all those projects. Like the profit margin is at the tail end of it. So there's a lot to carry through there. And then trying to assess the risk and who's accountable and who's not accountable is a pretty high risk profile that I need to evaluate and come up with some better tools. So like bridge financing sounds good, but how can we get into that process earlier with that quick turnaround period? And is that the right tool or not the right tool? And how much financial how much should I borrow against that, and then how to put that into the proposal at the beginning, like that cost, somebody's going to carry that cost. Right now we're not putting it into like the application process. It seems like somewhere that should also go into the application process. Just, I guess, everybody should be evaluating that's helping with the grant writing, like who's covering that risk and that cost, and what is that cost? That's a lot of questions. That's I just wanted to paint the scenario.
Yes. That is a very complex scenario that you've outlined there. And I think there's a lot of pieces that come into play on how. So I will not have a single individual answer for you here, but I would love to chat with you more after to get into some of the real weeds of that situation. Because you have risk to manage, and each individual customer has risk. And I think, you're rightly thinking about how do you bear that risk and where along the ways. A few specific things, I would think about in your shoes are like your technology. Is it something that you can go back and grab if they don't get it, or is it gone and like you can't recollect on that? And how do you suss out? I will say one thing for people that are vendors like that, where you may be having people owe you a fair amount of money and you're contemplating how to manage it. It is possible to get credit reports. Most people can get credit reports and understand it. It is not a perfect tool, but it will give you some information that you did not have before on that front. Those are a few things specific to you, and then I think that's a good question on that broad spectrum. I don't think
I'm looking for like local partners too, so like if there's a potential risk, I can send them early in the process. Yeah,
and we would be happy to talk either with you for financing or with the individuals, buying that technology, as far as lending relationships and things.
A related question, you mentioned that you would like to have an application come in after the grant's been awarded and before work happens. Without understanding loans enough, what's the harm in applying for a loan before you know if you got a grant or not? Because if you're not spending any money, you're not paying interest on it either. Is it your risk?
It's really the efficiency for everybody involved, right? It's a process. We go through a process, the applicant goes through a process. I want to have those discussions so that we all know kind of this makes sense, this doesn't make sense. But there is an inefficiency. Now, I blatantly will recognize that not all projects have that time, have the luxury of time. And if they don't have the luxury of time, they don't. And we start sooner in the process. But if we do have the luxury of time, there's an inefficiency to going through that process, collecting all of those things, doing the site visits, if the project's not going to happen. And that's for everybody involved. Yeah.
Awesome. Thank you so much, Andy. That was great.
And if folks have more questions for Andy, feel free to put them in the chat and we can circle back to them as well. I think there'll be a lot of time at the end of the session for broader questions too.
Yes.
Okay.
All right. Our next presenter is Tracy Derry. Tracy is a lifelong resident of Franklin County. She grew up in St. Albans, lived in Fairfield and Sheldon for a while, and now lives in Swanton. While she never lived on a farm, she has held a deep appreciation for the importance of farmers to our society and economy for a long time. Her early lending experience was with the People's Trust Company of St. Albans during the late 80s and early 90s. She has been working for FSA for 28 years on farm loan programs and on commodity credit corporation programs, with a focus on loan making starting in 2018 when she became a loan officer. She plans on retiring in May of 2026, and we're super excited that she's here with us today to share her knowledge.
Good morning. Thank you, Morgan. Andy did a really good job going over all the more detailed stuff than I'm going to talk about, but FSA follows along with a lot of the same processes that VAC has, or the Vermont Agricultural Credit Corporation has, with respect to what's required for an application and the timeframes. So I work in the St. Albans office, which is in the old post office building in St. Albans. We're on the back side downstairs, and the St. Albans Loan Office covers Franklin, Grand Isle, Chittenden, Washington, and Lamoille County farmers. If farmers are located in other counties, then it would either be our office in Middlebury that would be working with a loan applicant, or our loan office in Newport. So my presentation is really focused on bridging the cost of conservation contracts. The slides you'll see in here are also applicable if it is not a bridge loan. There's only slight differences between the two, and those will show up and be obvious as we're going through this. So FSA has two types of loans that could bridge a conservation loan project. One is the farm ownership loan, and the other is a farm operating loan. And you can see on the slides where the different conservation practices might fit into either type of loan. And you can also see the loan limits that we can hit while we're looking at these projects. So you can see that the farm ownership loans are for practices that become a permanent part of the real estate, where the operating loans are practices that can be removed in some manner and sold if the loan doesn't get repaid. The trees and shrubs and seeds and the land grading and shaping obviously become a permanent part of the real estate, but sometimes we can slide those into an operating type loan. Just have to get into the details to know if that'll work or not. So on this slide, we see the differences between eligibility for the actual producer. They're all the same except for the financial management and production management qualifications. If we're doing a farm ownership type loan, you've got to have 3 years under your belt, where if we're doing an operating loan, depending on the amount and complexity, it can be as little as 1 year. Also on this slide, which is different than maybe VAX eligibility requirements, is if another lender is willing to fund the project, FSA is not able to. We're only allowed to lend to producers who can't get loans with other ag lenders for security reasons or cash flow, tight cash flow reasons. So we're willing to take a higher risk, but if another lender is willing to, then we can't. This is information needed for a complete loan application. Andy was touching on this. We also have to have a copy of the actual approved or obligated contract award to consider the application complete. We also will require vendor estimates. So whatever agency is awarding the contract may come up with their estimate on the cost of the total project without actually getting vendor estimates, or look online and looking up products and getting screenshots of what certain items of equipment or hardware or whatever is needed. But FSA needs that information. We won't go off just what the award grantor is estimating. We want to see actual estimates. Our financial information, if the loan is for more than 50,000, we want 3 years of financials. If it's less than 50, then it's only 1 year. And we don't need tax returns if it's 50,000 or less. There's some entity requirements that are a little more involved. If you're an LLC or a corporation, we're going to want copies of all the legal documents related to those. And if we're doing a farm ownership loan, part of a complete application is a legal description of the property, because we will be taking that as security. Documentation of environmental compliance is also important with FSA because we're federal. Normally, we don't see an issue with that, especially if NRCS is involved in the project. They also have to follow the environmental compliance rules. Once in a while, we'll run across something where there's some missing documentation, and normally NRCS will get it to us. Let's see, loan terms. We have different security requirements for a farm ownership loan versus an operating loan. Interest rates are different. The term of the loans are different, and the amount of time it takes to close each type of loan is very different. The amount of the loan, Andy was getting at this, is based on the vendor estimates and looking at contracts. But if the borrower or the producer has to come up with some portion of the project costs on their own, that's where we come into the length of the loan. If the award is going to cover everything, and we know that it's going to be a short-term loan. But if the borrower, the producer, has to come up with a significant amount of money, the loan can become longer. And depending on the type of loan, farm ownership versus operating, that's what ends up determining the term and also the farmer's ability to pay back based on financials submitted. You'll see the difference in time between the farm ownership loan and the operating loan. With the farm ownership, it can be between 3 and 10 months, and the operating loan is much less time. And the reason with the farm ownership loans is because of real estate descriptions, title opinions, and if necessary, appraisals. If title opinions and appraisals are needed, the title opinion work is, the cost has to be paid for by the producer, but FSA will cover the cost of appraisals. With respect to the timing, what Andy was talking about, not submitting an application until you actually have approval of an award. FSA runs a little different than that. We will do a lot of work with a farmer ahead of an official application. Once we have an application on file, if it's not complete in 37 days, it gets withdrawn. We also will do a financial analysis ahead of an official application, just to give the producer an idea of what's going on with their income and expense cash flow without the project, then what's going to happen when they go through with it. And we will help them decide their best move forward with what Andy's saying, what type of loan they want to get and with who, or if it's probably not feasible for them if they have to cover a significant amount of the cost of the projects. So we do a little more. Our policies say that even if the farmer doesn't end up getting a loan with us, part of our job is to help them decide. And we can do that without an official application on file. And then other kind of things that we haven't talked about yet in the previous slides is that FSA will require a direct assignment of grant funds for application to the loan. And that will be either before a complete application or prior to approval. We'll actually ask the agency that's awarding the grant to sign a assignment so the money comes directly to us when it's paid out and get applied to the loan. There are credit report fees involved when the actual application is filed. We talked about title opinion and appraisals if it's a farm ownership loan. If at any point before approval it becomes known that there's going to be cost overruns for any reason, we can relook at the loan amount and the feasibility to see if increasing the loan amount is an option. And once you are on, if you get approved for a loan and it's a longer term loan than 1 year or 2, we will every year look at your financial situation at a minimum every 2 years to determine if you can graduate to other credit, which means your operation becomes strong. You can afford the higher interest rates of commercial ag lenders. And it doesn't, put you in a tough spot if you end up refinancing with us. So we're called a progression lender because the intent is not to keep you on our portfolio if you don't need to be. And also, if you get a longer term loan with us, we're going to inspect security every year. If it's chattel type and if it's real estate security, we'll come take a look every 3 years to make sure that things are being maintained appropriately.
All right, thank you, Tracy.
You're welcome. If anybody has any questions, feel free. We also have Ryan on the call. He's the district director here, so he could chime in if I'm struggling with an answer or just has anything he wants to add.
I guess I have a question, just in terms of how do producers prove that they can't get a loan somewhere else?
Well, they can actually have already applied with another lender and got an actual denial. And based on what the reasons for the denial are, like if the reason is for bad credit, then we aren't going to be able to lend either. But if the reason is lack of security or a really tight cash flow and it's too risky, those are reasons another lender would deny them. Or we can just tell if the farmer has submitted enough financial information to us and we're looking at what's going on, we're going to say they're never going to meet, you know, a commercial ag lender's criteria. So there's a couple ways.
I was curious, I've never heard of the term progression lender. I wonder if you could expand on that a little more or talk a little bit more about what that means.
Sure. So when FSA gives loans to producers, it is because another lender won't lend to them because they don't have a strong balance sheet, like their assets versus their debts doesn't leave them with a lot of equity, or because their cash flow is tight because they're beginning and they don't, you know, they're not profitable yet. So we're going to take on those accounts, and every year we're going to be reviewing their progress to see if their, you know, profit is going up, their operation is more efficient, if their equity is getting better, like their assets are increasing and their debts are going down. And it's our job to help them determine how to improve those things. So as they're making progress with our guidance, when they get to a point where they're strong enough, where their equity is good, their cash flow is there, they're getting a good profit, they're going to have made enough progress to graduate to commercial credit. So that's where the term progression lender comes from. We're not a lender who intends to keep producers on our portfolio for the term of the loan if they make enough progress.
Yeah, great. Thank you for clarifying.
You're welcome.
You guys might be able to answer this too, but what does someone who doesn't have the 1 or 3 years of experience with bad enough credit to go to FSA, or bad enough, won't get funding somewhere else? Like, what does a brand new farmer do for lending?
A brand new farmer with FSA is the only way they can get a loan with us, and it's got to be an operating loan, you know, for not a lot of money. It really has to be mostly that 50,000 or less, is if they can have a mentor who's an established farmer, who's either known to the farming community or can prove to FSA that they've been farming and they know what's what. And that producer will make an actual mentorship plan with the mentor, with dates and what the mentoring, you know, what the mentor is going to be mentoring on, the specific parts of the operation, whatever the production or financial management is, and it's got to be well written up and acceptable to FSA.
Tracy, you might have mentioned this already, but I was wondering if there's a minimum amount for an ownership or operating loan that can be applied for.
Yeah, it's not the amount of the loan. The minimum amount of gross income that a farm has to produce to be eligible is $1,000.
Okay.
As far as a minimum loan amount, that's going to come into play when we're looking at feasibility, right? So if a farmer's asking us for a $500 loan and they've got $3,000 in their checking account, we're going to say, you know, you don't need a loan for that amount of money. You can afford it. to pay it. So there really is no minimum loan amount.
And farmers have multiple loans at the same time with FSA?
Yes.
Okay.
I was curious too, and this question I sort of had for everyone here. If there, when a farm, if a farm does come to you with a signed grant agreement, if the repayment plan for a loan that they're requesting can be set up in tandem with the dispersal date of the grant award.
Yes, it can. If the grant award isn't going to be paid out within 12 months, there has to be at least an interest payment made on that loan in that first 12 months. But the big amount due would be lined up with the timing of the grant award payment.
Okay, so interest does start to accrue when the loan is awarded.
That's an interesting question. We did run into this. It wasn't with a conservation project, but we don't have to disperse funds at closing. We can close the loan and hold on to all of the funds, and there would be no interest accruing. And if for some reason we didn't make a disbursement for a whole year, there would be no interest that accrued. And then the system would say, but you have to make a payment within the first 12 months. So we ended up having to disperse the funds, even though they didn't need them. So that interest there would be some interest accrual. That only happened once. It's really rare.
Okay, that is interesting.
Does FSA mostly just do conservation, like funding NRCS contracts, or do you fund state of Vermont grants projects as well?
We have not, we are all grant fund projects will be entertained by us, but we haven't done a lot of them.
Okay.
Yeah, so in this office, I've only seen operating type loans to bridge conservation projects, and they've mostly been high tunnels. It just, we've had some inquiries on some of those more farm ownership type practices, and it doesn't seem to work. The timing doesn't work. There's the farmers don't like pledging their real estate for security for something like this. And I can't remember one that we have done on the farm ownership side. It's been the real smaller amounts on the operating loan side, and all with NRCS, but sometimes the state has a part of it.
Yep.
And it depends on the situation. We don't always assign the state grant or Fish and Wildlife. It just depends on other things to each unique situation, but we haven't done a lot of them.
Okay. Thank you.
You're welcome.
All right, thank you, Tracy.
Thank you.
I think if there are no other questions, we can move on to our last presenter. So Alexander Robb is from Community Capital of Vermont. He's the executive director at Community Capital of Vermont. He was previously a registered investment advisor at Mirror Lake Advisors and spent time as a program director with the Washington Central Unified Union School District as well. He's been with Community Capital of Vermont for 5+ years. We're really grateful he's here and look forward to learning more about lending with Community Capital of Vermont. Welcome, Al.
Thank you very much. Do I press this to proof slides? All right, Community Capital of Vermont is different than the other two institutions that you've just heard from. We are generalist. We specialize in smaller loans across the state of Vermont. We work on all different sectors. Most of the loans that we do are under $50,000, and we specialize in $15,000, $25,000, $30,000 loans. We work a lot, referrals from banks, from institutions like Vita. Basically what we do is we spend a lot of time trying to put square pegs around holes. We work with all of the loans that nobody else either wants to do or can figure out how to do, with a special emphasis on helping low-income people find the loans they can get to uplift themselves, uplift their communities, and grow their businesses. We are a mission-based lender. We're a nonprofit. We have a board of directors and a couple of loan committees. We have several loan committee members with agricultural experience on our loan committees, which gives us experience working through some of these tricky situations. We do a lot of loans to women-owned businesses, 62% last year. And 78% of our loans were to low-income entrepreneurs. We're what's known as a community development and financial institution. It's a designation of the U.S. Treasury. In order to meet that designation, we have to do at least 60% of our loans every year to low-income business owners. So we get to 60%, and then we have some room to do some other loans. So we have a very simple policy with a lot of clarity. We offer one interest rate, 7.5% right now. That's the Wall Street Journal prime rate. If the interest rates are changed in the future, that rate will go up and down. But we have a very transparent interest rate policy. If you apply with us, you know what your rate's going to be from the beginning. We try to, once we have a complete application, which means you've submitted all of your documents, we approve within 10 days. So we offer transparency on timing as well. And a lot of times when you go to get a loan, you'll find that it's a little bit of an opaque and murky process. And you're not exactly sure what's going to come out on the other end. We weight experience very heavily. We really like to see people with 3 to 5 years of experience in their field and really like to see some kind of responsibility for generating revenue or sales. And we have a flexibility on collateral as a nonprofit lender. So if you have collateral, say you come to a loan with us to buy a farm stand and you have a home, the odds are that we are probably going to ask you to put that collateral up. However, if you come to us for the same loan and you do not have the collateral, we can move forward without it. So that's kind of us just in general. We did a lot of work during the flood. We're known as an SBA micro lender, which is a small program with the Small Business Administration. We get a lot of referrals from the district office, the SBA. If you call them, the SBA in Vermont, and ask for information on small loans, they're probably going to send you to me. And we also are a USDA Rural Micro Entrepreneur Program. I guess we have a contract with them, so we do have some USDA funds as well. So here's a couple examples of what we've done. So this is Alicia's Country Goodies. This was an EQIP grant. I have it down here as a USDA, but it was an EQIP grant to make a high tunnel. She's a canned good manufacturer in West Charleston, works in the local school, as the school chef, but also does this on the side. This was a reimbursement grant that we funded and then were repaid with the proceeds of the grant. We did this thing, I think, in 2009, and we're now working with her on a second loan to make a commercial kitchen for the next step in her business. So that's the kind of things that we'll do. We have a little more flexibility on what we can loan for. So like a commercial kitchen is a good example of something that someone often comes to us for. Here's some other projects that we've done recently. Wilson Herb Farm is in Greensboro. They have a large herb farm. They also have a cannabis operation, and they have a farm market and ice cream stand near Lake Caspian. They sell a bunch of herbal ice cream, including, they obviously sell mint ice cream, but also lavender and other flavors. And we have done a series of loans to them to help them build up this farm stand, which has been a very, they also sell bulk herbs. So it's been a very good part of their organization. It's created a lot of cash flow for their business. And it's right next to the Highland Center, so it's been a important addition to the town as well. Westminster Wagyu Farm. This was actually an FSA ownership loan that is just wrapped up. We did this loan for this Wagyu beef producer. He earlier this spring got very concerned about tariffs. He had purchased a couple cows in Canada and some genetic material as well, and wanted to expedite the purchase and the movement of those cows into the United States. And he approached us. He recently closed on the FSA farm ownership loan, but there was just some issues in terms of the FSA's loan pending and how that might impact the collateral and the lien on the home. And a lot of other lenders weren't interested in stepping in because of the collateral situation being in flux. So we gave him a $15,000 term loan to get the genetic material that he needed and bring it across the border before the tariffs hit, which actually they ended up not hitting, but that's another story altogether. Old Soul Farm and Berry, $25,000 term loan for a commercial kitchen to create a line of canned, pickled and baked goods to improve, income and sell in the local Berry area. Some other things we've done, we did a loan for a compost heat reclamation business called AgriLab in North Enosburg. They install very large systems to pull heat out of compost piles. These are large projects, these municipal projects, and he needed a line of credit in order to buy the materials that he needed and construct the systems and then sell them off. So we were able to do a $50,000 line of credit for Brian and AgriLab. And, we just have many, many small loans over that time frame. So, the way we usually work is it starts off with a phone call, either myself or one of my coworkers, and we learn a little bit about your project. And then we also ask for personal and business financial documents. So that include profit and loss, taxes, bank statements. We'll pull your credit, and we have an application as well. And then if it's an existing business, we'll ask for balance sheet and a profit loss. We do loans to startups based purely on projections. You'll find that if you go to banks around the state, often they will not do startup loans. They want couple years of income taxes and business history. And I would say about 50% of the referrals that we get are for startup businesses. And we are a little more selective on startup business. Again, experience is our number one weighted factor. When we want someone to have experience in their field, preferably in some kind of revenue generating or position that's responsible for sales and revenues, or at least managing the business. But we will take a business plan and a business cash flow projections, and we will make loans based on that moving forward. So how to get started for us, you can give us a call, you can email us. Here's our website. We try to operate on a human scale in an increasingly AI generated world. So that, what you'll find a lot of times is if you apply for a loan and you go through a large bank or a lender with a large footprint, that they're all going to use the same algorithms to look at your loan and determine if it's fundable or not. So we actually act with people. We actually call references. We talk to people. We find that often, references can be a great way to find out if someone believes in your business. For a lot of our startup businesses, we love to see a GoFundMe or some kind of Kickstarter campaign. We like to see someone put their idea out there into the community and test it out. A lot of our most successful businesses have, before they started as businesses, they were able to launch Kickstarter or other funding campaigns that resonated with their community and showed that their business plan was going to be successful. Yeah, so we're willing to do bridge loans, basically anything, as a nonprofit, our goal is to lift up these low income entrepreneurs. The best part of my job is probably about 1 in 4 or 5 people that we work with find out that they actually have a talent for running business, and they kind of discover that they're able to do it. And that's really rewarding. Probably the other 3 out of 5, their business stays about the same. And, if the reality is for the other person, these businesses don't always work out, but the one thing I would say about that is if you have an idea for a business and you've been kicking it around in your mind for a couple years and you've worked on it, and I would really encourage you to take a shot. Set some guardrails around what you're going to do and how far you're willing to do, but it can be a lot of work. But if you really believe in what you're doing and are passionate about an area, again, it can uplift you and your family and your community, and sometimes once in a while, it can really create something great. We've been around for 25 years. We've had some original of our businesses go up and become very large companies. So yeah, we typically do a site visit, and we like to see what we're investing in. So we're kind of a generic across the board lender, but where we really come in is to like complement the programs of the FSA, complement what Vita does. Come in, like if there's a piece that they don't want to take over, we are happy to take a smaller piece of the loan, maybe the riskier part, if we feel like there's a potential to help a mission client and to advance economic development. So I tend to be pretty quick and to the point. So yeah, I mean, I don't know if anyone else has any questions at all, but again, I'd be happy to answer anything.
Perfect, thank you.
Looks like Molly, you have your hand up if you want to come off mute and ask your question.
Yes, thank you. If I'm going to create a hypothetical, if there's a dairy farm and they're looking to diversify and start a cut flour business, and they've been farming for 20 years, but this is sort of a new venture that they don't have sort of any financials to show to sort of back it up, is that going to be viewed as a startup basically? Or will sort of the history of the farm be taken into consideration?
We would look at both. We definitely want to look at the history of the existing business, because that reflects on the foundational business and personal finances. But what we would ask for the new venture is we'd ask for some cash flow projections. We have templates that we can share out. We work a lot with the Vermont Small Business Development Center, which is a network of advisors all over the state that help you refine and develop business plans. It's a free service to anyone. So either we have grants for technical assistance from the Small Business Administration and the USDA. So we have people on the ground that can come out and actually help you refine those projections. So we would want to look at the existing business, but we'd also really even be more interested in what the projections are for the future business as well. So yeah. We've done a couple cut flower farms over the years. And to be honest, we have a lot of clients in like the wedding food chain that involves, florists, cake makers. Like that's an area that we've been very involved, tourism over the years.
Thank you.
Yeah. A few other things about us. Again, like we operate in this Small Business Administration micro entrepreneur program. The way that works is we get loans from the Small Business Administration at about 2 or 3%. They loan us the money directly, and then we lend that out at our 7.5% rate. We do charge a 1% origination fee, 1% of the loan balance. So that on a $15,000 loan, that's $150. Typically, we will put a lien on the business. It's a UCC lien. So most of our small business loans are secured by the business assets. So if you have a farm stand, it would be secured by the items in those farm stands. That's the main security that we ask for. Our terms are typically up to 5 or 6 years. One of the reasons why we may not be the best choice for a large loan is because of those short terms. Our payments can be larger than what you would expect. Like, we're not the best fit to buy a building usually because of our short-term terms are 5 or 6. You have to cram all those payments into that. And we don't do any kind of balloon loans where you would get a lower amortization schedule. We do subordinated loans. So typically a subordinated loans is when you have 2 lenders in a deal. So an example of a subordinated loan that we did recently, we did a Quick Stop in Barrie. Community National Bank did the loan to buy the building. They did the loan to do the gas, the fuel, and we came in with a $50,000 line of credit to help the business build its inventory. That's a very common scenario for us. We do offer small lines of credit. A lot of times, businesses need lines of credit. They can be very hard to get in the $15,000, $20,000, $25,000 range. An example of some lines of credit is we've been active in the maple sugar industry over the years. We have 3 or 4 maple sugaring clients, and we've done 2 types of loans for them. We do lines of credit where they take the money out in the fall and they buy the equipment they need, and they they install their stuff in the woods, and then the sugar comes in and they pay us back. We've also done some seasonal loans over the years. So we had a sugaring loan in Worcester where it was a $50,000 loan to buy equipment for the sugaring operation, and he made 9 small interest-only payments and 3 very large payments in April, May, and June. So I think it was a $50,000 loan. I believe the monthly payments were $200 or $300 throughout the year, and then there were 3 $2,000-ish payments in that time frame when the cash coming in. The one thing about lines of credit for us is we do want to see some kind of fluctuation in your cash flow that necessitates a line of credit. So we don't just do lines of credit so that you can get $15,000 in interest-only money for 12 months. Like, we want to see a cash flow fluctuation on a seasonal basis. And, obviously in farming, those are very common, like maple sugar would be in a lot of retail operations, farm stands, they have startup costs that they have to incur, and then they pay those down with the profit of their operations. And so a line of credit can be a very useful tool. That, lines of credit are also very useful in disasters. After the floods, we had a huge spike in interest in our lines of credit because businesses that had been, given a little bit of a scare in the flood, they came to us, they applied for the line of credit, they submitted their financials, and then the line of credit is approved. And then when something bad were to happen, you're already approved, you call us up and we send you a check the next day. So that can be beneficial for a lot of businesses as well to have that line of credit. Lines of credit are a little more risky. So we charge 8.5%, which is a percent higher, which isn't a big much more. Yeah, so that's Community Capital of Vermont. I would say there's another organization like us in the state called Vermont Community Loan Fund. They're not here today. They're very similar to us. They're a little larger. They actually have I think they have a couple specialized programs. They have one, I believe, called Sprout program that's geared specifically for ag businesses. So that would be another option as well. But really, like, in the continuum, we're the smallest, and then Vermont Community Loan Fund's probably 10 times bigger than us, and then Vita's probably 10 times bigger than that. So that's kind of the continuum that we operate. And those are the main kind of nonprofit lenders in the state of Vermont. And the only other one I probably would mention is down in the south, and that's the Brattleboro Development Credit Corporation. And we actually partnered on them with the Westminster Wagyu Farm for the loans to support them. So again, we pride ourselves on flexibility. I've spent most of my time, it's endlessly fascinating to me, all the different things that people are doing, all the different businesses, why people do those things. And like, the best part of my job is learning about people and learning about their businesses. I started as an equity analyst for 15 years, and I analyzed very large public companies. And now I do the same work, but I work with the farm stand down the street, and it's really rewarding. So yeah, that's Community Capital of Vermont. I'll open it up to questions, if any more questions, if anyone has. Otherwise, it's a beautiful day.
Yeah, thank you so much.
Yes.
Another question for you, and maybe I've brought to, so UCC filing, so like FSA, I believe takes 125%. Of the loan, so it becomes, that piece becomes challenging to get like a good interest rate on an operating loan. How do you guys do that?
We're gonna look at the whole collateral situation, so we look at the total value of collateral and compare that to the lien. But again, because we're a nonprofit, like collateral is desired but not required. So we like for instance the Wagyu farm, like that was the FSA loan. They were going to have the lien on the primary residence. So we took a secondary position. So, you know, we as a subordinate lender, if we feel that in order to move your business and Vermont's economy forward, that taking that second position, even if it's under collateralized, we would move forward with the loan. So that's part of what makes us a mission lender, is we're willing to take those risks, offset by the fact that we don't do very large loans. You know, we don't have $200,000 loans that we would take that risk on. We have a maximum loan size of $100,000, and to be honest, once you get above 50, our loan committee is more selective. But yeah. So we would look at it, we look at your balance sheet, we compare it to the UCC filings, but collateral is just one of the things. Like the experience weight, the cash flow is just as important for us.
This is a stupid question. What's a UCC filing?
Yeah, so when you go and register your business with the state of Vermont, you go in the Secretary of State and you create your business entity, and you have to file those annual reports. There's a whole nother parallel system called the UCC lien system, and lenders use it to keep track, and other people keep track of who owes what. So say you have this business, Wilson Herb Farm, in the Secretary of State system, there's a filing, and anyone can look it up and they can figure out, you know, where they are and who the principals are and how to contact them. And then when a lender goes in, they file what's called a UCC. UCC is Unified Commercial Code, or a Universal Commercial Code. So it's a standard across the entire state and the entire country, maybe the world, where we would go in and we would file something under your business name that says Community Capital of Vermont has a first priority on your business assets. And that means that our loan is secured by the assets of your business, your tractors, your ice cream machine, whatever. And so when another lender goes in, they can see that. So when you apply for a second loan, they'll say, oh, well, you put these, you know, this tractor on your balance sheet, but I can see the Community Capital actually and so in the event that something goes badly, say you go bankrupt, what will happen is you'll file for bankruptcy, and the lender that has the first lien, made you the first loan, say you have $100,000 worth of stuff in your farm that's going to be sold off to lenders, and I'm simplifying this a little bit, and we had a $20,000 loan to you, we would be the first one. We lent you the money back in 2006, and we've been doing it so long. So, and then there's another lender who did something more recently. In a liquidation scenario, we would get made whole to our $20,000 before anybody else would get made whole. So it's basically a prioritization resource. And I don't know if just anybody can get in and see it, but yeah, you can. So you can go to the Secretary of State, you can make an account, you can file, and you can see. So we look at anyone who applies for us, we will pull up their Secretary of State account and we will check whether UCC lines. The other thing we often do is, now that most property records are available statewide online, in the old days you had to go to the town clerk, you had to like open up the vault and you had to look. Nowadays, for almost every town in Vermont, that's not true. You can go online, sitting at my desk, and I can see all the property records and any liens that you have, which saves a lot of time.
My Secretary of State question, and maybe that's the question. So a couple of things. I think on our filing, you got a couple of UCCs that are like paid loans that are still hanging there. Do you call Secretary of State or the vendor?
Just call the vendor.
Call the vendor.
Call the lender and give them a hard time and ask them to remove those UCCs. So it definitely happens. You should, whoever the bank is, they should remove those right away. You know, typically they've charged a fee. So we charge what's called a UCC filing fee. It's $80. It costs us $45 to file the UCC, and then it costs us, I believe, $35 to take it off of the end. So you'll see that fee sometimes on loan, a lien fee or whatever, an $80 fee or whatever it is. And that's because we collect the money to file the fee and then we have to file it at the end. So UCCs only last 5 years. So what'll happen is that so that may be something to check in that situation, is that after 5 years they expire. So you can go into your UCCs and they may not, like, we don't always take off UCCs. It's called lapsing. We just let them lapse. So a lot of times we'll be in a situation, we have a lot of 5-year loans. Maybe they've missed a few payments, especially during COVID. So maybe they're like 5.5-year loans. A lot of times we just let in order, you have to pay to renew the UCC for another 5 years. We'll just let it lapse. So check if a UCC probably will be in there, but it might be a lapsed UCC if it's older than 5 years.
My other question was, can anybody file a UCC if
It's an honor system.
someone owes you, it's your asset, you can file the UCC and then you incur the fee?
Technically, anybody can file a UCC. It's an honor-based system, just like everywhere here is Secretary of State. You should monitor your Secretary of State systems. We've had businesses where there's been 2 or 3 owners, and one of the owners has filed with the Secretary of State to remove another owner without their permission. So you definitely monitor your Secretary of State account. You know, most of them just sit there and you do have to, but especially if you're in a partnership and someone else is in charge of the UCC filing and you're not the partner, it's definitely something to keep one eye on because it is an honor-based system. And if you wanted to say challenge a UCC, typically that involves hiring a lawyer, which can be very expensive these days.
Challenging the Secretary of State.
Like, say someone filed a fake UCC, an inaccurate UCC on your business. Typically, you have to go get a lawyer, or you have to operate outside the Secretary of State to get that fixed. You can't call the Secretary of State and say, hey, this is wrong. They'll say it's an honor-based system. You need to go back. And that can be very consuming. Yeah.
And I'll add the Secretary of State's website for UCCs is really a notification system. It is necessary to perfect your lien, but it is not what causes the lien instrument. So you couldn't file a UCC on somebody just because. You would have to have supporting documentations. Now, if you're a vendor or somebody like that, you may have that in your sales contract such that you could, but you may not. So in our case, in lender's cases, it's within our loan documents, the security agreement, the UCC perfects that for public notice. So there is additional steps beyond that would be needed if somebody were looking to perfect the lien.
Odds are, if you bought a Kubota tractor for $16,000, there's probably a UCC filed on your farm by the Kubota dealer, or whatever. You know, that's what I mean, 9 times out of 10, when I look at a farm, it's some kind of small tractor loan. But yeah, so yeah, it's an interesting system. And it just kind of helps us all. So when you do a balance sheet and you send it in, expect your lender to verify. Like, I know Andy talked, like, everything you submit. So if you submit a profit and loss, we're going to ask you for bank statements and we're going to be verifying. So when you say you have this loan, we're going to look for the payment on your bank statement and we're going to check it off, you know. So when you do financials, you submit your profit and loss, you submit your balance sheet, we will start verifying. We'll go on the property records. We'll verify that what you told us is accurate. We'll look at your loans. We'll make sure that, you know, there's not a lot of, you know, there's a lot of loans now that don't report on credit, Square loans, other financial technologies. We go in and verify everything. So, you know, we trust everything that someone sends us, but if we start to like get down a road where we're not sure what's going on, that we'll follow that path until we figure out what's like going on. So yeah.
Okay, I was wondering if you could talk a little bit more about the business planning resources. Could someone come to you with like a dream that they have and sort of like talk about that with you and
Yes.
Yeah.
Yeah. So we get what's called technical assistance grants from the Small Business Administration and the USDA. They help find people that we have on staff. And the number one thing that we do is help people prepare for loans. And that typically involves cash flow projections. We're a big believer that you have to operate your business with your eyes wide open. And that means knowing how much money you make. So I hear a lot from people like, oh, I'm really good at, making herbal ice cream, but I'm not good at running my business. So I would urge you to correct that situation. I've gone into businesses and, I've sat down with them, I've worked on their thing, they've realized they haven't made money in 2 years, so it's really important if you have a business to project your cash flow, understand your finances, just so you're aware of the fact that you're spending your time wisely. And you might be better off getting a job in the end. So we do one thing that we are very serious is we really we want our businesses to be very serious about understanding their finances, understanding where they're making money, and understanding their cash flows, and so that they are in a position of strength. So
Could someone come to you with the intention to maybe apply for a loan and go through that business planning stage with you and then decide a loan maybe isn't the right option for them?
yeah, the two pieces are separate. So the technical assistance and the business planning. And again, there's a whole network of advisors called the Vermont Small Business Development. I think there's like 7 or 8 of them across the state. They're part of the UVM system, and they are available for free. There's also, resources of the state of Vermont, the Vermont Housing Conservation Board, the Farm Forest Viability Program. Those are other technical assistance resources that businesses can get to just give them general advice and to make connections. Like Vermont is a very person-to-person lending state. So like, we offer, a lot of what we do is like someone will come to us and I'll say, oh, okay, you want to buy, it's like, say you want to buy, a fire extinguisher maintenance company. This happened the other week. But it's $350,000. Like I know to send them, like the first place I'm going to send them is Vita, because it's a business with great cash flow, and that's exactly the kind of loans that Vita will do. So, another resource right now is Vermont Community Loan Fund is offering a program called the Justice Forest Fund. That's for people who have been historically underserved in our financial system. If you are a farmer or someone who meets that definition, either either BIPOC, which is the main reason, they have an amazing program right now. Loans up to $50,000, interest rate of 2%, no collateral required. So if you happen to be in one of those underserved populations that have been historically underserved by our financial system throughout the last 50 years, that would be a great option. And we have done, those loans go up to 50,000. We've done a lot of like secondary $15,000, $20,000 additional loans for those kind of businesses. So just getting that first phone call to someone like us or someone at Vita who's very connected, you might find that they're willing to recommend you to someone who might be the best deal and the best fit for you. So again, it's a small community of lenders in Vermont, and we're competitive, but we're also like very friendly. And I think we all want to move Vermont forward and move everybody together. So,
Great. Thanks so much.
yeah, thank you.
All right. We'll just say a big thank you again to Andy, Tracy, and Alex for presenting today. I hope everyone was able to learn a lot. I know I learned a ton. And yeah, here's some contact information for those folks. If anyone has any additional questions, feel free to reach out to the Franklin County NRCD. Our email is at the bottom of this slide. Thank you all for coming to this event, and hope you can get out and enjoy the rest of the beautiful day.
Thank you. Have a good weekend.
Thanks, Tracy.